Cancer kills millions of people each year. While at the same time, modern cancer treatments are growing increasingly successful, but unaffordable. We face a future where life-saving treatments are effectively unavailable for a large segment of the population. But research from Chicago Booth's Ralph S.J. Koijen and Columbia's Stijn van Nieuwerburgh argues that life insurance policies could be used to finance cancer treatment. In the United States, a standard 12-week treatment for melanoma costs more than $159,000, while treatment for blood cancers can reach more than $500,000. While health insurance may cover much of the cost, out-of-pocket expenses, including deductibles, co-pays, and insurance premiums, can add up. The researchers calculate that cancer patients with private insurance under the Affordable Care Act may pay $20,000 to $33,000 out of pocket. But when cancer patients live longer, that's good for both the patients and life insurers, which benefit from paying death benefits later and receiving additional insurance premiums in the meantime. So is there a way to use life insurance to help patients live longer? The researchers find that a life insurance policy with a death benefit of $362,000 would more than cover the $159,000 cost of a 12-week melanoma treatment. Even a policy with a face value as little as $45,000 would be enough to cover a patient's out-of-pocket costs of $20,000. Broadening the analysis to 17 other cancers, the researchers calculate that if all patients would have access to these treatments, insurers would reap a large windfall of $7 billion annually, which could easily cover the patient's $4 billion of out-of-pocket expenses, leaving insurers $3 billion. A life insurer may not want to fully cover the costs of immunotherapy, especially if there are patients who could pay for it themselves, although there is increasing evidence that the stress associated with the out-of-pocket expenses can have adverse health consequences. Still, there are alternative solutions. For instance, life insurers could allow policyholders to borrow against their plans or reduce the death benefit, and to use the money borrowed to pay for treatments. This would lower patient stress levels at no extra cost for life insurers. And what if life insurers were to get into the health insurance business and offer insurance that covered what a patient needed to access life-extending treatments? Life insurers would increase life expectancies and potentially lower the cost of life insurance. They'd also improve their own reputations by saving lives. If this model were to work for cancer treatments, it could be extended to cover the costs of other kinds of life-extending medical treatments.